Today we're going to go over how to get pre-approved for a home loan in 90 days or less. So a pre-approval is your first step on your path towards homeownership. It's a lender's conditional agreement to offer you a mortgage based on an evaluation of your financial standing. In this section, we're going to detail why a pre-approval is important, we'll demystify the process, and we're going to provide you with a clear roadmap on how to achieve it. So why 90 days? 90 days is an optimal time period that's going to allow you to strengthen your financial position. It's also a realistic time frame to correct any credit inaccuracies, save that remaining amount that you need towards your down payment, and it allows you enough time to get all of your financial documents in order. So let's look at this from the lender's perspective. The lenders are going to want to see a few things. They want to know your credit history, your debt to income ratio, your employment history, and with that, income stability, and they want to see your assets. So the first step in your pre-approval process is going to be your application submission. This initial step is going to require you, the borrower, to fill out an initial application that gives us a picture of your financial history and information. It's during this point that we're going to perform a credit check. They do this for a few reasons. A, we need to know what your credit score is. And then B, we also need to know how much your monthly payments are. And then C, and a big reason why this process could take 90 days is if we find any credit inaccuracies, we need at least 30 and up to 90 days in order for us to help you fix that situation. We're also going to need to perform some document verification. We're going to ask you to provide us various documents such as income statements, tax returns, and your pay stubs in order to verify the information that was submitted on your application. So once we've completed that part, we'll go ahead and assess what we think that you're pre-approved for, which is essentially how much we think you can borrow. So once you're approved, we'll send you a copy of that pre-approval letter, which more often than not is going to be required when you're submitting your purchase agreement. So as you can see from this pre-approval process roadmap, step 1 is your application submission, step 2 is your credit check, step 3, we're going to verify all of your documents, and then step 4, we'll perform that assessment. As long as everything matches up at that point, we'll go ahead and issue that pre-approval letter. So what exactly are we going to need in order to issue you that pre-approval? Here's a quick checklist as far as the most common documents that we need in order to get you that pre-approval. Now, if we need anything else, we'll be sure to let you know right away. But as you can see here, we're going to need the following: 2 pieces of identification, your last 2 pay stubs, 2 months worth of bank statements, your last 2 years W-2 or 1099, and then your last 2 years of tax returns. So in preparation for your mortgage application, organizing your assets is a crucial step that's going to let the lender know that you have the financial resources necessary for a down payment, closing costs, and other related expenses. And a real quick tip, we have a video that's going to explain the differences between down payment and closing costs, and we'll go ahead and provide the link below. But for now, here's how to get your assets in order. So the first step is going to be the documentation of your assets. What you're going to need to do is collect all of your recent statements. Now we're going to need 2 months of your checking, your savings, and any investment accounts that you're going to use for the transaction. We're also going to need documentation for any retirement accounts that you have, something like a 401k, an IRA, or a 457. Now, if you have any large deposits that are showing on any of these statements, what we're going to need to do is we're going to need to document this, and we'll go ahead and walk you through how to do this. So essentially, it's called a letter of explanation, and we'll show you how to do this in the process. So the second step, we're going to source your down payment. Essentially what this means is that we're going to need to identify where your down payment is coming from. Now, if your down payment is going to be gifted, we're going to need something called a gift letter that shows where that gift fund is coming from. Now, the easiest way to take care of all this is to ensure that your down payment is in those accounts that you want to use at least 2 months prior to starting this process. That way you can avoid any funds that need to be sourced. Now, the third part of this is maintaining your asset stability. Essentially, all this means is avoid any large purchases or moving money in and out of accounts. And the reason is, if you do this excessively, it's going to raise a red flag with the lenders and require a lot of additional documentation. Just remember that the lenders are going to be reviewing all of your financial activity a few months prior to your application. Now, the fourth part of this is proof of any additional income. This is referring to any income that you're getting from dividends, interest, or rental properties. So if you're going to be using anything like dividends, interest, or rental income, make sure that you have the proper documentation available. So this is going to include any tax returns, rental agreements, and maybe some brokerage statements that show a consistent income stream. Now, step 5 is something that's called reserve funds. Now, lenders may require you to have reserve funds in your accounts in addition to your down payment and closing costs. These reserves are typically enough to cover several months of mortgage payments. So step 6 is explain or eliminate your debts. You're going to want to pay down significant debts if possible, as this will improve your debt to income ratio. And remember, be prepared to explain any outstanding debts or liabilities to your lender. So now that we've gone over what we need, let me give you some tips to help you out during this portion of the process. Start early. Begin the asset organization process well before the 90-day mark to ensure everything is in place when you're ready to apply. Step 2 is keep records. Maintain a file of all of your asset documentation. This is going to include any statements and letters in order to streamline this portion of the process. And the third tip is understand your liquidity. Some assets may be liquid, which just means it's easily converted to cash, while others are not. Lenders typically prefer funds to be liquid as they're easily accessible. So how does this impact your mortgage pre-approval? Having your assets in order demonstrates to the lender that you're financially prepared for your home ownership. It can affect, number 1, your loan amount. The more assets you have, the more you can qualify for. It also can affect your interest rate. A strong financial position can affect your interest rate and your loan terms. Better terms may be available to those have a stronger financial position. We're going to start off by explaining how your credit score actually comes about. Then we'll discuss how to improve your credit, and then lastly, we'll go over how to maintain that good credit score. How exactly is your credit score made? So where does your credit score come from? Well, specifically for mortgages, we're going to be using something called a FICO score. Many times consumers will pull their own credit score that's different than what we're going to pull, and we'll go into why. So as far as how your FICO score is comprised, let's go over how it's made up. So there's 5 different factors, and I'll show you here on this pie chart. 35% of your score is going to be made up of your payment history. 30% is going to be how much you owe. 15% is going to be the length of credit history. 10% will be made up of new credit, and then 10% is going to be credit mix. So why is payment history 35% of this score? Research shows that your track record of payment tends to be the strongest predictor of the likelihood that you're going to pay all of your debts like you agreed to. Amount owed is referring to the debts that you carry in total. What's interesting though is that the amount of debt that you carry is not as important as the utilization. So what does this mean exactly? When a high percentage of a person's available credit is used, this will tend to indicate that somebody's become overextended. And then because of that, they're more likely to miss payments. So what exactly is credit history? So your FICO score is going to take 2 things into consideration when it comes to credit history. How long your accounts have been open, including the oldest account. They're going to look at the age of your newest account, and then they're going to look at the average of all of your open accounts. And then secondly, they'll look at how long specific accounts have been open. So what exactly is credit mix? Credit mix is the type of accounts that you have open. They can be credit cards, retail accounts, installment accounts, finance accounts, and then mortgage loans. And the reason this is important to your score is they want to see how you handle a variety of different types of debts. So new credit, what exactly is that? New credit includes inquiries in the last 12 months, and an inquiry is essentially when somebody pulls your credit. So why does any of this matter? Well, when it comes to applying for a mortgage, your credit score is going to be a vital piece of the puzzle. Now, although it's combined with other factors, depending on how low or high your credit score is, that's going to dictate your interest rate, which in turn is going to dictate your monthly payment. The best possible credit score will give you the lowest rate, lowest mortgage insurance, and so on. So now that we've gone over what your credit score is comprised of and why it matters, let's talk about how we can improve your credit. The number 1 thing that we discuss with clients is credit report accuracy. We need to make sure that we get your credit report early in the process, which is why we talk about the 90-day process, to address any inaccuracies. Once we have a copy of that credit report, we'll go over everything to make sure all the accounts listed are yours, and we'll also discuss any of the negative information to make sure that A, it is yours, and then B, can we address it and get it removed from your credit report. So the second tip we're going to discuss is lowering your credit utilization. Now, in the simplest terms, all we're going to ask you to do is pay down your debt. But what we're really trying to do is get every single credit card that you have below 30%. The reason that we're going to ask you to do this is if you stay below 30%, your credit utilization ratio is going to actually improve your credit score. The third tip is consistent payments. Now again, this seems like it's common sense, but continuing to make consistent payments is a huge part, 35% of your score. So while you're going through the loan process, it's vital that you don't miss any payments. The fourth tip is avoiding new credit. I cannot emphasize this enough. Do not apply for new credit while you're in the middle of a mortgage process. There's nothing worse for me as a mortgage broker having to call a client to let them know that the new appliances they bought or the new furniture put their credit utilization ratio above 30%, it dropped their credit score, and now that the interest rate that they qualified for previously is no longer available. And even worse case is when we have to tell them that they no longer qualify for the loan. Now, let's say that you need to improve your credit score. Either you can't qualify for a mortgage currently, or your credit score is lower than you would like in order to get the best rate. So let's go over the timeline for credit improvement. We like to suggest 90 days in order to address all of your issues, whether it's credit report inaccuracies or paying down your debt to lower your credit utilization ratio. Within 90 days, if there's anything that we can do to improve your score, this gives us enough time to handle it. Now, as far as monitoring and managing your credit, so in addition for credit improvement, once we get that score up, what do we want to do to manage and monitor that credit score as we go through the process? Well, there's a few things that we've already discussed. We'll go ahead and reiterate them now. Do not take on new debt. This will increase your credit utilization ratio more often than not, and for each inquiry that you take, that's going to possibly lower your credit score. There's tools like myfico.com that are on the internet, which allows you credit monitoring that I highly suggest you use. So I hope this gives you a better understanding as far as your credit score and what part it plays in the process. So this is not intended to be an all-encompassing discussion on credit scores. We do have something like that, and I'll go ahead and leave the link below. So let's discuss the top 10 things not to do when you're buying a home. While it's important to know what to do while preparing for home ownership, it's equally crucial to be aware of the pitfalls that can jeopardize your mortgage pre-approval or the final loan approval. Here are 10 actions to avoid. Number 1, do not apply for new credit. Each credit application can cause a small dip in your credit score. Lenders may view this as increased risk, potentially affecting your loan approval. Number 2, don't close any current credit accounts. Closing credit accounts can affect your credit utilization ratio and length of credit history, which can lower your credit score. Number 3, don't make large, unexplained deposits. Large deposits can raise questions about the legality and source of the funds. Lenders need to ensure that no additional debt obligations are created from such deposits. Number 4, don't shift finances around without a paper trail. Lenders need to see the source of all funds, so keep a clear record of any transfers and deposits. Number 5, don't co-sign loans for others. Co-signing affects your debt-to-income ratio and could impact your ability to qualify for a mortgage. Number 6, don't change jobs or become self-employed. Lenders look for stable and reliable income. A new job or self-employment status can introduce uncertainty. Number 7, don't make large purchases. Big ticket items like cars or appliances can affect your debt-to-income ratio. Wait until after closing to make significant purchases. Number 8 is don't skip bill payments or make late payments. Remember, your payment history is 35% of your credit score. Late payments can significantly impact your credit score and your lender's confidence. Number 9, don't spend your savings. Remember, you're going to need funds for your closing costs, down payment, and reserves. Look at it this way: depleting your savings can be a major red flag for lenders. And number 10, don't be unresponsive to lender requests. During the pre-approval and underwriting process, be prompt in responding to requests for information. Delays can slow down the process and potentially harm your application. We are here to help you to get your loan approved in the shortest amount of time as possible. We always want to leave ourselves a big window in case anything comes up. Here's a few extra tips. Consistency is key. Maintain your financial habits and avoid any large changes. Stay informed. Regularly check in with your mortgage broker for advice if your situation changes. And then be proactive. Address any potential issues with your broker early to avoid surprises during the application process. So what impact will these 10 tips have on your approval? Avoiding these 10 actions can have a direct impact on the success of your mortgage application. Not only do they help in maintaining a good credit score, but they also present you as a low-risk borrower to lenders, which can result in a smoother pre-approval and underwriting process, better mortgage terms and interest rates, and a stronger chance of a final loan